Welcome back to the Financial Shepherd Podcast. My name is Joshua Casey Garland, certified financial planning professional and owner of Shepherd Wealth Management. Very excited today to be back on the mic doing another podcast on Monday, May 9th. And it has been a rocky ride here in the stock market for 2022, and woke up on Monday and I don't know why I should have expected something different, but I kind of was hoping for something different. That's just not the case. So here we are.
A little Monday mayhem, we're back at it.
Yeah, that might be the best way to describe it, is mayhem so far in the markets. So just to start us off here, just in case you've been so busy at work or you've been hanging out on the beach or some other place for the first 5 months of the year, it's been a rough start. So the Wilshire 5000, starting with the large index covering all stocks, down 21% here year to date. S&P 500 down 16% year to date and falling as we're still talking here. The NASDAQ also falling, down 25% year to date. Dow Jones down over 11%. The Russell 2000, which is your small cap index, down 21%. And believe it or not, the bond market is down over 10% year to date as well. So there's really no safe place to hide here, Ez.
No, there's not. And I'm glad you went over those numbers, because I have been living in a pineapple under the sea and had no clue what we were walking into this morning. So
yeah, I would have stayed underneath that pineapple if I could have.
I tried, but you made me come into work.
But you know what the cool thing is, and the reason why I love what I do, I mean, it's always nice to have excellent quarterly reviews because we're beating on the upside, but it's just as important to beat on the downside, because the reality is those who lose the least right now are going to be those that are probably going to be in the most beneficial performance position as we come out of this recovery. And that's really the job here, is managing risk at the moment.
Yeah, I mean, we talk about temperament all the time here on the podcast as well. And these types of dips, unfortunately, are part of it, but not a better time in any of your investing cycle to really practice what you preach and, lay down the strategies to not just throw everything in the fire and go live in the pineapple under the sea.
Yeah, and I think maybe the guys that do live in that pineapple are Warren Buffett and Charlie Munger, and they're in their 90s. Probably the best investors in my lifetime, maybe of all time. She was recently asked, right, because they had the Berkshire shareholder meeting. You have to be a Class A share owner, which is going for north of, right around $500,000 a share. So I'm not an owner of any of that, although I'd love to be invited to the shareholder meeting. But he was asked about timing the market, which I'm not sure why somebody asked Mr. Warren Buffett those types of questions anymore, because he's always, for like 60 plus years, come out and said timing the market's impossible and it's very stupid. But here was his actual response at this time. Quote, "We haven't the faintest idea what the stock market is going to do when it opens on Monday." And he could not have been more right. And, oftentimes he is right. And he also went on to say I don't think we've ever made a decision where either one of us, talking about either Buffett or Charlie Munger, where either one of us has either said or been thinking, we should buy or sell based on what the market is going to do today. Like, it's just not how they think. They do the research. They talk to management. They do all the boring stuff. They sit on cash for longer than what most people would feel comfortable sitting on cash for. And when the timing's right, they deploy it. So he just deployed in this first part of the year here, as I just mentioned, all these terrible numbers.
Yeah.
Everybody else thinks the sky is falling. What does Buffett do? He takes 30% of his cash and he starts buying into either current positions that he already owns, such as a Chevron, so adding more to that. But he's also, continuing to add into other parts of his portfolio. I mean, he obviously owns Geico and other insurers, but he's going to purchase another insurance company. Over $41 billion in the first part of the year here, when everybody else is running for, the sell button on their computer. He's just armed and ready to go because he's done the work and he's been patient. Even though he'll admit, like you just said here, I can't time the market. I don't pick bottoms. I don't pick tops. Like he admits he missed out on the pandemic, March 2020, when everything, really the sky was falling.
Yeah.
And it truly did feel like that. And, he admits he should have put money to work there and he didn't. But I think his track record's been pretty great. So it's just funny when you listen to the things that he'll say in response to some of these questions. And I think that's the right way to go about thinking about your own personal portfolio as well. It's certainly something that we try to emulate here at Shepherd Wealth Management. But the good news is on Wednesday, we should be getting some core CPI data, which is really what the Fed's main data point is as it relates to decisions they make with inflation. Now, it's not the only data point that they look at, but it is something that they repeatedly say, like, this is the most important thing to us when we think about our job as it relates to fighting against inflation. And the last reading was right around that 8.5% number. Analysts are expecting maybe something closer to 8, so coming down a little bit.
Right.
I think if we see something like that, I think you'll have a nice little pop in the market. It might be very short-lived, but I do think that that's a key data point here this week that not just the Fed, but all investors will be looking at. But before we get into the meat and potatoes of today's topics of conversation, as I know that we have some questions from viewers here today, but there's a couple of them, or I think at least one that was kind of a question that stemmed from the last podcast that we did. And I maybe wanted to start out with that. So what is the question that we got here for us?
Well, Brian's back again. He wanted to know more about annuities.
Brian, I'm just going to have him come in here. Me and Brian are going to have some coffee, maybe even like an extended conversation over lunch. We'll see.
Yeah, I would love to meet Brian eventually. I don't think Brian's missed a show. But yeah, Brian wanted to know more about annuities. You went into that a little bit at the end of the last podcast, season 2, episode 1 on YouTube and Spotify, for those of you that haven't caught it yet. But so here's Brian's question. You mentioned annuities last episode. Has the continued volatility in the market made them any more appealing?
Yeah, I mean, I would say that not only is the question a relevant question for right now, it's always a question from investors, people that, they know what I do, family members, friends. Those questions come up in moments like this, right? When it's the most volatile time, that's when people start to look around and say, okay, what's safe?
Yeah.
And we just went over the numbers. I mean, bonds are down over 10% year to date, right? I mean, there really isn't a safe place to hang out. I did a little research before today's podcast as usual, and the 60-40 asset allocation, which is a classic asset allocation for financial planners like myself, have been recommending that to retirees for decades. Mm-hmm. And that thing is down almost as much as the S&P 500 is this year, which is mind-boggling, right? I mean, you think, hey, 40% of my money's in bonds. That's the safe part. The risky part's the stocks. Well, that hasn't worked out well this year at all, which is unusual to say the least. So the question of, how's my tone changed on annuities because of all this? Yeah. And the answer is certainly no. And the reason why is because I can say, yes, I've recommended annuities when I worked at Fidelity Investments. That was a tool that we used, and not all annuities are bad. I do want to make that clear. I think annuities, you should think of them like a tool. It's just a financial tool, and under the right circumstances, might be the perfect tool for that individual's situation. It also could easily be a tool that's completely worthless, right? If we need a socket wrench, and if the annuities, the screwdriver, well, there's no real point in using that if that's not something that we need to build whatever it is that we're trying to build. In this metaphorical situation would be a comfortable retirement, but it very well may be the perfect tool for some individuals. Now, here's the reason why I say that. Speaking from real world experience, both in recommending annuities and not recommending annuities for clients, I've been in both situations. So where does it make sense? Usually when an individual is solving for an income gap in their retirement plan, right? So annuities are the oldest financial tool in the toolbox. They've been around, going back to, the glory days of Roman Empire all the way up until present day today. It's the oldest financial tool that's been out there. Usually the best case scenario for an annuity recommendation is there's an income gap. So what does that mean? It means somebody that's retiring or is retired and they have the quality of lifestyle cost them about $5,000 a month. Let's just pretend. And let's say Social Security only covers $3,000 of that. And they could make up the other $2,000 from their investable assets, their 401ks, their IRAs, et cetera, which can cause taxable events. And it's not a guarantee, right, that the money that you have in that 401k or the IRA is going to last forever, right? If it's invested in the stock market, fixed income market, et cetera, it's very volatile. We just went over all the volatility that we're seeing right now. And sometimes volatility lasts an extended period of time. So if you're trying to solve for that $2,000 income gap, and an annuity will get you there without completely depleting the investable assets, because one of the worst things you can do is take all of your investable dollars and invested in any one thing, including annuities, because the problem with an annuity is, you get the guaranteed paycheck every month. Let's say that $2,000 to fix the gap, but you don't get to call up, Geico, which is a Warren Buffett company, and say, hey, Mr. Buffett, I want that $150,000 that I invested in the annuity back, and I don't want your $2,000 checks anymore. It doesn't work that way. It's a contract. It's done once it's done. You know what I mean? But under the right circumstances, if we don't need to take out too much of investors' liquidity from their IRA, 401k, et cetera, if we can take a reasonable amount out and put it into annuity to fix that gap, well, great. Now we're in kind of the Goldilocks scenario for a retiree. What I mean by Goldilocks is you would love, I think everybody that's retired or hopes to retire one day would love to know that they have enough money coming in from predictable, guaranteed sources that has nothing to do with the stock or bond market to cover their normal lifestyle costs. Like that would be the ideal scenario. So in this scenario, $5,000 is the monthly lifestyle cost that person's happy with or couple's happy with, and Social Security is paying them $3,000, and they can get an annuity to give them the other $2,000 without completely drying up all their other liquid assets. Well, now guess what they get to do? They get to probably be a little bit more aggressive than the average retiree because they know they're going to wake up every day of the month, and their lifestyle cost is going to be covered by something that's guaranteed. It has nothing to do with the stock or bond market. So in those types of scenarios, an annuity can make some sense. Now, we're talking about really one kind of annuity here, which is a fixed guaranteed income annuity. There are a ton of other types of annuities that are variable, that are investing in the market. And the other thing that we haven't talked about is the fees. So that I gave you the reason why an annuity might make sense, like where the tool could make some sense, right?
Right.
Where does it not make sense? In almost every other scenario. I've never had an investor come to me that's invested into an annuity and just been like, hey, look at this. Like, look how awesome this investment is. It's never happened. Not one time. I think people buy annuities for the security, the protection, the guarantee. And I think they get sold these other annuities that are, like I said, a whole bunch of other ones.
Yeah.
That really it's better for the person that sold you that product than it is for the actual investor. Like I mentioned, they're in most cases very illiquid. If you can get out of them, there's usually a hefty fee to do so. There is a hefty fee just to have the product itself. And the reality is, in my experience, is that most people that go that route or even consider going that route, they don't know all the things that they need to know about annuities. Like if you actually look at an annuity prospectus, which nobody does. I mean, they don't even look at, mutual fund prospectus or ETF prospectus. They don't look at them anymore. But an annuity prospectus is like, the Old Testament kind of thick. Like nobody's.
I'm definitely clicking the I agree button on that. I'm not reading that anyway.
Exactly. So they get locked into these things. It sounds good in the presentation, and usually a few months go by and they just don't understand it. They get frustrated with it. When they find out about all these little intricacies with fees and all that sort of stuff, I've never had anybody say, hey man, this is the best thing that I've ever done and everybody else should do it too. Maybe there are some people out there that feel that way, but in my experience is you either have more than enough money to create your own annuity, so you don't need to go, buy one and pay all these fees and all that.
Right.
Or you don't have enough money to put towards an annuity to get you the payout rate to solve that income gap that we talked about earlier. Like you don't want to have, just like you don't want to have all of your money in one stock, you don't want to have all of your money into one financial product. In this case, we're talking about annuities. So I think there's a very small percentage of investors out there where an annuity makes some sense as a part of a well-diversified portfolio. And I truly don't think that my answer is ever going to change from that question, because if you just do a quick Google search and type in annuity payout rate, it's like 5.5%. Okay. So if I'm a long-term investor, and to me, long-term is at least 5 years, maybe 10 plus is probably a better definition for long-term, because then you start to get to more correlation between long-term S&P 500 performance over 10-year periods of time, right? But at least 5 years. I really think that if you can't average, like as an advisor, professional, I do this for a living, helping people with their retirement plans and managing their assets. If I can't help somebody generate a 5.5% return net of fees over that long period of time, I need to go find something else to do.
Right.
Like I literally need to go find a different profession if I can't make that happen. And most people don't know that if you look at the S&P 500 over a long period of time, if you had half of your money in stocks and half of it in fixed income, and I'm not saying that that's the right recommendation for any of my clients right now, but historically, 50% stocks, 50% fixed income over a long period of time, going back to like 1929 all the way till today, that asset allocation averages about 8%. Right? The market, S&P in this example, averages 10. So if I were to come up to you and say, hey, S, you can get 80% of the market's return by taking on half of the risk, like, doesn't that sound like a much better situation to be in than parking a bunch of money into an annuity that generally is going to have super high fees and not very liquid, if liquid at all?
I mean, I'm just spitballing it here because you put me on the spot, but yes, yes.
See, these are the conversations that I think should be had. I think these are good questions, though. And I like the question. I don't like the tool.
Right.
For most people.
Yeah, the main thing is just the non-liquidity of an annuity, and certainly not something to be used as a way to dodge volatility. You can't get that money back. Yeah,
and I think most of the time, in my experience, advisors are positioning this. It's almost like a fear tactic.
Yeah.
Right? And they're going to use events like this as a reason for people to consider that product. But what a lot of investors don't actually know either is that for some of these products, like equity-linked indexed annuities, right? Talking about a long prospectus for that one.
That's the old and
you don't even need
bits of the Quran as well.
You don't even need a license for that. Right? You just got to go pass a life insurance exam.
Yeah,
which is like the easiest thing in the world. My 13-year-old daughter could pass that test with zero financial knowledge. You just need to understand what a fixed and variable annuity is. It's 50 questions, and that's it. Like you don't even need to have experience. Like you just going to go pass this test and you can sell some of these products. And it's unfortunately given advisors that are trying to do the right thing, like what we're trying to do here at Shepherd Wealth Management. We don't use annuities at all or any of those types of commission products. We don't use commission mutual funds. We don't use any of that stuff. We try to do all the things the right way, the way that I would want them to be done if somebody was managing my money. But unfortunately, that part of the financial services industry gives a lot of folks like ourselves a bad name, or at least a bad perception. Right, from the general public.
Well, Brian, there you go. You certainly hit a nerve with Joshua. We got about...
And it's okay. We can still be friends, Brian. Keep watching the show. I love the questions. But we can have this annuity conversation in more detail that's specific to you. Maybe it is the right tool for you. I don't know. But I'd love to have that conversation with you anytime. Hit me up, 513-630-2664. So what else we got, Ez, before I get to some other stuff I want to get to?
You want to go ahead and we got a couple more questions I was going to save till the end. You want to knock down now?
Well, we'll save them for the end. We already had that kind of set up here.
We said this last time. I think maybe doing a show a little more in depth on annuities when, our reflexes about them calm down a little bit would be good. We could also maybe get someone on here like your daughter or myself to take that test to see if we can start selling them.
That's a good question. I could probably print out an old version of that test, and I guarantee you give me 10 minutes with almost anybody, I can help them pass that test in 10 minutes of prep.
Well, let's do that. We're going to make an announcement towards the end of the show about switching formats to the YouTube Live, so that could be a good good first event.
So I know we got other questions to get to, but I was doing some research, as I always do. Right, I'm very in tune to what's going on here, and
big time data.
There's certainly a lot going on here in the market so far this year, but all is not lost. So I get this all the time when I send out monthly newsletters to clients. I always give them the facts. I usually start out with, just like I did with this podcast, like what actually is going on in the marketplace performance wise. And then I try to give them a positive spin, an optimistic viewpoint. And the reason for that is not just because I want people to, just bury their head in the sand and pretend like everything's fine. But the reason why I do that is because when you actually look at the numbers and zoom out, right, get out of the emotional turmoil that we're in today, this very moment, or even so far this year, if you zoom out, it's hard to be pessimistic about the market. It's simply positive about 75% of the time. It will be down 25% of the time. And this time is no different. So I did some homework before today's show, and I wanted to prove that. As opposed to just me just saying that, I wanted to use some hard facts. And the hard facts are this. It's a really cool chart here. I think that we'll be able to post up with some editing as after the show. But if we go back to 1980, all the way until present day, the S&P 500's average yearly drawdown was 14%, which means some years during the year, going back to 1980 to now, the S&P lost or drew down more than 14%, some years less than that, but the average since 1980 was the S&P drew down 14%. Here's the cool part, and the reason why I'm always able to stay optimistic from a long-term investor perspective is that since 1980, 32 of those 42 years were positive. So you could have a year where the S&P is down 14, 15, 16, 20 plus percent some point in time during the year and actually still have a really nice market year from a performance standpoint. Like going back to 1980, where we had super high, the highest level of inflation that we've ever had here in this country. And that seems to obviously be the headline news. Every time you turn on TV or read a news article is inflation, inflation, inflation. Well, in 1980, the S&P drew down 17% at one point in time during the year, but it actually finished the year positive 28%, right? I mean, we can go on and go back through history and look at stuff like this, and time again, oh, by the way, 32 out of 42 years, that's 76% of the time it's positive, right? There's this thing called statistics that I think people tend to forget about when it comes to doing their research.
Right.
And this is the type of stuff that we like to find. We were actively looking for a chart like this, and thanks to FactSet and JP Morgan for producing this great piece of content here. It's absolutely the type of thing that you need to find more information about, as opposed to trying to do, some research on some weird annuity that your neighbor or the person you went to church with, decided to say, hey, this is something that you need to buy, Frank or Brian. Maybe actually take yourself out of the emotional turmoil and do a little bit of homework. And that's exactly what Warren Buffett would tell you to do as well.
Got to have that BDE, the big data energy.
That's right.
Best way to curb temperament.
Exactly. And then, on the other side of this, I know we're going to talk about the NASDAQ here in a little bit, since that's the sector that's been beaten up the most so far this year. As I mentioned at the top of the show, down 25% and still falling as we're talking at 238, Eastern Standard Time here on Monday, May the 9th. But if you go back to the tech bubble, which was arguably the NASDAQ's worst one-year result of all time, Amazon's still around, but there was a much smaller company back in 2000. Amazon went down to a low of $5.51 in late 2001.
Wow.
Right? We already know, Amazon was at one point in time around $3,700 a share.
Yeah.
Since come down from there. But if you would have invested $1,000 at that point in time in late 2021 in Amazon, it would be worth almost $50,000 20 years later, right? I mean, that's the kind of information people need to get their arms around. But the problem is if you were an Amazon shareholder and, it was hanging out around $100 or so, and then it falls to $5, would you have the intestinal fortitude, I think is the most respectful way to say it, the cojones to stay with it, or for that matter, invest more in it, right? And the very first thing that I look for, so there's two things we talk about all the time. There's only two things you can control. When you break it all down, you boil it all down, there's only two things investors can control, because you can't obviously control the market. You can control your asset allocation, that percentage of your money invested in stocks, bonds, and cash, and you can control your temperament. Temperament, to me, is the key. Buffett would agree. Famously said that he would hire somebody with a high level of temperament over somebody with a bunch of degrees from Harvard and MIT any day of the week and twice on Sunday. But those are the two things we can control. So how do I control my temperament, which is, to me, the most important of the two? I start to seek out information. I want to do more research. I want to understand why it is that everyone's running for the hills, when I know in the back of my mind, I always hear this, maybe people have the little angels and devils on one side of the shoulder or another, but when I start to get super pessimistic, I always step back and try to think what Warren Buffett would do and say, hey, the market's up 75% of the time. Mm-hmm. It will be down 25% of the time. We just need to have a game plan for dealing with the market when it's both good and bad. Right. That's getting back to controlling the asset allocation. So doing the homework, controlling those two things, long-term, you'll have a tremendous amount of success. So those are the charts that I wanted to get to. As I know, we got a couple more questions I think we wanted to get to here today. So what do we got for us? Anything else on annuities? Or we got something different this time?
We got something different. You're gonna this one's gonna be a good one for you, Joshua. From the first time texter line, Sandra from right around here in Cincinnati said, "Would you recommend diversifying with gold and/or crypto as a means to get through the current volatility?"
Wow, it's a good question. What was the name?
It's from Sandra.
Sandra, here in Cincinnati. All right.
Yeah, from the first time texter line. Sandra's not texted into the show before.
All right. Well, Sandra, welcome to the show. Thanks for watching. So I think the question was, would I want to add gold or crypto, specifically Bitcoin, to a well-diversified portfolio in this market for protection?
It says to get through the current volatility, but I think what Sandra was referring to is maybe just like a kind of temporary reallocation, as a way to kind of, some folks you do that with certain currencies, right? Wait out volatility. I believe that's what they were saying.
Yeah, so I'll answer it from that perspective. That's the way I had heard it as well. So first of all, what is why do people buy gold? Right, is because they want to hedge against inflation. It is an actual asset class.
You can bury it.
Right. It did used to one time back the dollar as what they call the gold standard. And it can actually be pulled from the ground, mined. There's a marketplace for it. It's been around a long, long time, obviously. So yeah, you could say that gold historically has been a way to have a part of your portfolio be protected from things like inflation and from things like the stock market in general, because, in history would show that as the stock market gets more and more and more volatile and people start to hit that panic button, more and more often, they tend to gravitate towards either bonds on a normal interest rate type of year, not this year, or they'll go to gold or something else that will help them, hedge against inflation risk and have an asset class that can actually appreciate in value when things like the stock market are not performing so well. So I guess the real question today is gold a better hedge against inflation and a asset class for protection in volatile markets, or should we go the crypto route?
Right.
Well, crypto market, as we're talking here, is down about 32, 33% year to date. So it's trading more like the NASDAQ than it is like gold or even bonds, for that matter. So I would not say that the crypto market, because it's still a very new asset class and doesn't have a long track record of history, it would be very difficult for me to convince myself, let alone a client, that this is the best place, or at least a good place to protect against inflation and potentially see, capital appreciation. And I think that the way that it's moved so far this year, closely in line with what the NASDAQ has done, makes some sense to me.
Yeah.
Because crypto, yes, there are more and more places where you can buy things with cryptocurrencies. And I think you'll probably continue to see more and more of that come out just as time goes by. But I think what's interesting, I think we had this brief discussion over lunch, was I think the reason why crypto is kind of trading like the NASDAQ, and it's traded more volatile than the NASDAQ has, don't get me wrong, but it's similar because to me, you're not buying crypto. I don't own crypto, but if I did make the investment, to me, I would want to own the technology more than I would want to own the ability to exchange crypto for groceries, right? I think the technology is what gets people excited about it to begin with. I think that's still the real benefit of owning crypto is you're getting into that blockchain technology, which is probably going to be a big part of the metaverse and a whole bunch of other things at some point in time in the future. So I think that correlation between the NASDAQ makes some sense to me. But I couldn't, with a straight face, say that this is what I would do. If I wanted to hedge right now, what I would consider doing at this moment in time and what I'm doing for clients right now is we're adding to our energy holdings. That was something that we did right at the end of last year, beginning of this year. Last year, energy was the best performing sector in the S&P 500. Year to date, it's really the only thing, that and utilities, that's positive. Energy's up about 27%. Utilities are up 5% year to date. Everything else is in the red. So what we're doing is we're actively going in there and taking some profit out of the energy space, still adding to some other energy sectors as well, or energy positions, I should say. But we're slowly rebalancing out of the profits in energy and into other areas like technology and other parts of our clients' portfolios that have not performed as well. So that's that's our way of hedging against inflation, is by owning asset classes like stocks specifically have been historically the best asset class to own to hedge against inflation over long periods of time. And I think your home. So me personally, I've actually made a pretty sizable investment for my wife and I into our own home. We could sell our home and make a nice little profit, but then again, we'd also have to go buy something else that's also appreciated, 20+% within the last 12 plus months. And now mortgage rates are much higher. So we've made some investments in our home. That's a way to hedge against inflation, but your best way to hedge against inflation from a long-term perspective is to buy high quality companies, specifically in the stock market. But you got to be able to understand, what your real risk tolerance is. And that's the best way to build a diversified portfolio, and to know, how comfortable you'll be with having a certain percentage in equities. As we just talked about, since 1980, the average drawdown is 14%. So if you can't withstand something like a 14% or more type of drawdown within your portfolio in 1 year, then you probably have to look at other ways to diversify, because the stock market is not the place for, let's say, the bulk of your assets, if that's you as an individual investor and you're not able to handle seeing that sort of thing on your screen. So it's a good question. I think it's one that more and more analysts and people on CNBC are asking, what's the best way to hedge against inflation? To me, I don't think it's gold. I don't think it's crypto. I think it is what it always has been, which is really high quality companies right here in the United States. If you continuously rebalance, control that asset allocation, that's going to be your best bet for hedging against inflation for the long run.
Well, that's a good segue into our next question. Len from Cincinnati wants to know, how is the best way for me to determine my risk tolerance?
Yeah, so we still use suitability types of questions here at Shepherd Wealth Management, which is really just listing out what is the purpose of the money, what's our time horizon. On a scale of 1 to 10, 1 being I just want all my money in cash, I don't want any risk at all, and 10 being I want the most leverage as possible, the riskiest way to invest. Like, we do all those things. It's exactly what we did when I was working at Fidelity. To my knowledge, they're still doing that. They're still doing that at TD Ameritrade, firm I used to work for before I started Shepherd Wealth Management. So suitability is a good way to start. But to me, I think the real answer to that question of determining your risk tolerance has to be done either internally with yourself or with another financial professional that's a fiduciary, right? Where they have to put the client's interest above their own, which is why we don't use things like annuities and all these other commission types of products. The question I would ask is, why are we even putting the capital to work? Like, what is the purpose of this money? It's retirement. It's a home. Okay, well, what kind of home? Why that kind of home? All of those types of questions have to be addressed first. And then, oh, by the way, what did you do the last time we had a significant market correction? What did you do in 2008, right, with your own portfolio or whoever was managing that for you? Why did that go that way? How did you feel about it? Did you like it? Did you not like it? What would have made it a better experience for you? Like, those are the types of questions you either have to ask yourself or you need to sit down with a fiduciary like me, and we'll figure that out together, along with the suitability of the traditional way of going about trying to figure out what your real risk tolerance is. And last but not least, once we know all of that, okay, let's say it's for retirement. Well, how many years do we have to go to retirement? What's Social Security going to look like for you when you have your retirement years? Let's factor in inflation. Maybe you have a high amount of equity in your home. Let's factor that into the equation as well. Maybe you want to pay off your home before you get to, like, all these different variables. As a fiduciary, I can take all this information and put it into a software system called Money Guide Pro, which is pretty much the number one financial planning software in the industry. I mean, there's others, but that seems to be the go-to. That's what we used at TD Ameritrade. We used a very similar tool at Fidelity, where now that we have all this information, we can say, hey, if the goal is retirement in 30 years, and this is your savings rate, this is your spending rate, and all these other variables, including inflation, now we can run a Monte Carlo simulation, which is just 1,000 different market simulations with those exact variables taken into account for. Now I can confidently say to any one of my clients or prospective clients, like, hey, not only with all this information have we been able to come up with the right asset allocation, but now we've stress tested this asset allocation over pretty much every market scenario that's been around for the last 100 years.
Yeah.
And now we can easily say, hey, this is, this 75% of your money that we're going to invest in equities for you in this diversified manner, puts you in the best possible position to achieve the type of lifestyle you'd like to have by the time you hit retirement age. Like those are the types of things that we can do to get very granular and specific on what the right asset allocation is for a person, and literally be able to show them under a whole bunch of different market scenarios. Like this is the worst case scenario. This could be the best case scenario. Specifically on the worst case scenario, like if you saw this kind of decline in your portfolio, like how would that make you feel? Let's compare that to what you experienced in something like 2008. Like that type of information is what gives people confidence to invest for the long run, personally, outside of just figuring out what their asset class is, because I've kind of been stress test through all those different things. And I'll rerun that for a client on an annualized basis because I have all the information. The only thing that's changed is their holdings.
Yeah.
Right. And if something else significantly changed, we're probably going to find that out during our quarterly review anyway, when we go over all this stuff. So I think that's the best approach to determining the right asset allocation. As we're running up on time here, do we have any more, or we're going to save it for the next one?
We're going to have to cut it right there for questions. We got a couple announcements to make, I think, and then
yeah. So we're going to shift the podcast. You're still going to be able to go to s2ep2.com. It'll take you right to our Spotify channel where you can download all the Audible, as well as our YouTube channel where you can watch all of our podcasts and other content that we post there. We're going to shift the live podcast to YouTube directly, and that's going to be very exciting coming up here in a couple weeks. You'll start to see me do some other things as well. I don't want to give away too much just yet. We're going to amp up, I guess, the presentation here for some of the content pieces that we create. So certainly hope you guys have benefited from the podcast so far. Certainly hope that you got something out of today's. And of course, if there are questions, if there are concerns, if there's something that you'd like us to talk about that we haven't gotten to yet, maybe we want maybe some annuity fans to come on here and maybe challenge my perspective on annuities. That's all welcomed. But you can send those to me, 513-630-2664. You can also email me at jcgarland@shepherdwm.com. It's been a great pleasure. And don't forget to check out our Facebook, Instagram, Twitter, all social media. Shepherd Wealth Management is there for other content, as well as potentially being able to subscribe to our newsletter. So this has been awesome. I really appreciate it. Reading the questions. We'll do this again in about a week or so. And until next time, you guys have a great rest of your day.